Good morning, everybody. Happy Monday. Welcome to the Wealthpress Weekly Roundtable. I'm here with my regular compadres, Roger Scott and Jeff Zananiri. Gentlemen, how are you today?
Great.
Excellent. Thank you for having us, James. Always love being here.
You bet. Okay, so let's think about, or talk a bit about, rather, what are we looking at in terms of opportunities and risks in the marketplace this week? Let's kick it off with you, Roger.
Well, I think this week we're starting to see a lot more of what I anticipated to happen at around this time 2-3 weeks ago. Now, I know that sounds very vague, and I'll be more specific. I saw the market being extremely overbought on a short-term basis, and I saw this rally fizzling out. I've talked to Jeff about it. I've talked to Lance, and we've all talked about it. James, we've talked about it several times. And the bottom line is it's all working out exactly as we expected. Right now, my opinion is traders should be very, very careful, and we may see an acceleration to the downside before we have a soft landing. So this could be the second shoe dropping. We're seeing a lot more fundamentals catching up with the technicals, and it seems like all momentum levels, technical levels, and the fundamental levels are pointing to a downside washout, and partly a reduction of the trend that we saw over the last month and a half developing.
Mm-hmm. All right, and would you concur with that, Jeff?
I muted myself. Yeah, 100%. We were here last week saying that. And, here's the thing. I love buying stocks. I'm not like this perma bear. I'm a trader, though. And so we've had this 2-month rally that's been unprecedented. And I had a lot of buddies that were like, hey, dude, just go with the flow, man. You just got to buy this thing. And that was like, oh, my God, warnings, these stocks that are insolvent, companies with no business, Hertz, Chesapeake Energy. And so I had a beauty trade last week, fading that feeling on the drillers. I shorted XOP last week. I was on this show last week where I saw a short-term top in oil around the $40 level. We're now down to 34. I think it has lower to go. I'm riding the energy short. I'm particularly bearish on oil exploration companies that require oil to be north of 40. If we have a hard hat at 40, and these companies need 40 or higher, like well higher, to have a good solvent business, then I think you can get your derriere handed to you if you're not careful trying to rent those names for a few days. So I think there's going to be mega opportunities. I'm seeing financials getting barbecued a little bit excessively here. I don't know if it's quite the time yet, but I have a few that are on my list that I'd like to buy. And so I'm waiting for, as Roger said, that washout. I'm looking at a little bit lower on the S&P, 3 to 5% lower. The thing is, when you have a 7% day like we had last Thursday, or 6% day, this is not normal market action. This is high volatility market action. We went 5 years without a day over 5% on the downside in the S&P. 5 years. And we've been having them all the time. And so when people are like, we're back in a bull market, well, maybe not so fast. You don't have down 6% days in stocks on an index in bull market. It's not how it works. So just be cognizant of those chops and the ranges is what I'm trying to say.
Mm-hmm. And Lance Ippolit joins us too now. Lance, how are you doing?
Hey, Lance.
Hey, Roger. Hey,
Hi,
Jeff.
Lance.
Hey, James. Another busy morning with I feel like every time we hop on now, the past couple weeks, the open's been pretty crazy in the markets. And as Jeff was saying, you usually don't have overnight action and this volatility in a bull market, so to speak. So you have to really be on top and be on your toes right now.
Yeah, you bet. Okay, so then let's talk about some favorite expected opportunities to materialize. Jeff, why don't we start with you?
I'm looking at a washout in the banks. I think that the financial sell-off is one that is not consistent. I think so. I'm looking at the world like this. There are sectors, and Roger and Lance and I, we've talked about this extensively, and yourself, James, we've been talking about this for weeks, not just last week, like almost a month. There are sectors that are very closely tied to the real economy that are falling within the realm of possibly not having an actual business going forward. Those are stocks you have to be extremely careful for and wait for super crashes to play from the long side, in my opinion. They're good shorts on pops, actually. But there are sectors and there are stocks that are getting killed with like the baby getting thrown out with the bathwater that are going to be there. And they're going to be making a lot of money once things recuperate, which they invariably will. The banks are one of those sectors. Even though we're going to have low rates, that doesn't mean the banks can't make money. They're still going to have a nice, people don't understand that if rates are low, they're even lower for banks to borrow. They make money on that spread on what they borrow it at and what they lend it out at. And that spread is pretty wide still. And all this crazy trading stuff that's happening, that's great for the banks. They make huge money trading markets, handling like stock loans, M&A transactions, all these secondary offerings, bond raises. These are all ways that banks make money. And so I think the bank sector is one that I'm really focused on trying to get long here at a perfect point.
Yeah, I was speaking with the vice chairman of one of the bigger banks and on the weekend, and he was telling me that he's basically isolated himself at his country resort, but that he's very busy because the risk trade is very much on, and they are his focus is capital markets and the capital raising, and he says that they're as busy as ever. People are putting money to work in the longer term investment scenario of capital raises, and so he seemed to feel that the volatility was not really affecting his business, and that was across every sector. So in terms of the investors who deploy capital on longer term risk horizons, which is primarily you would expect to be fundamentally driven, he says that the disruptions in the status quo have created new opportunities for businesses to expand horizontally into other sectors where they had a peripheral participation. For example, a lot of companies that rented equipment are going in and buying the equipment manufacturer now because they're in distressed mode. And so he says those disruptions, those dislocations in this normal status quo have really created a lot of opportunity which needs funding, and therefore there's a lot of funding going on. I thought that was interesting. So, so specifically, some businesses are having an existential moment. Hertz, rental cars among them, the airlines. But other businesses, as you say, like the banks, are very, very, very active. In fact, some might say that the next couple quarters are going to look really good for them, which would not be inconsistent with what usually happens during a crisis. Jeff, you look like you have something you want to say.
Yeah, one just quick add-on to what you're saying. The speculation on those businesses that are already almost insolvent is that they will survive. There's reverse speculation in the banks that there's going to be a shoe to drop that we haven't seen yet. You see how that's working? The banks are being priced like something really ominous is going to happen to their earnings, which has not yet happened. And all these other sectors are getting priced in like there's going to be some miraculous recovery to their business, which doesn't exist. That's the differentiator. Sorry, I just had to get that.
So what do you think the chances are that the expectation around, say, Hertz getting bailed out materializes in the form of a direct investment from the Fed or through one of its special purpose
all of it
vehicles?
is bad for stockholders. I mean, we have a precedent of this. They dilute stockholders. They issue new stock, and the people that have stock get diluted by 90%, 90% plus. So you're essentially buying a call that you know has 90% decay in it, hoping that this big upswing in the business, because of it getting stabilized, will counterbalance that dilution of stock. I don't know. Shit's insanity to me. I used to short stuff like that until the government came in and said, the SEC would come and say, Jeff, you can't short sell that. That's a violation. 2008, you can't short sell these companies that are raised, these banks that are going to go through the stress test. It used to be legal. Now it's illegal. Why is it illegal? Because it's an easy trade.
Wow. Well, interesting. Lance, what's happening in your option universe? Is the flow as good as it was last week?
So we had record number, especially of call buying, short dated call buying too. And that's been a theme. Like every time we talk about the options market, I keep saying short-term flow, short-term flow. Nobody wants to make a commitment of capital out. I mean, I'm barely even seeing 30 days, let alone, 60, 90 days out there. I mean, what we call, front month flow. So the closest monthly expiration. And now with so many names with weekly options, we're even seeing weekly option flow. So 5 days or less, which, in a volatile market can be very difficult to trade. But, we had some stats come out on the number of call options being purchased, hitting record numbers over the past couple weeks. So that what that tells me is traders were betting on a quick upside to the market, and they wanted to get extra leverage by playing call options. Usually, when we see stats like that, usually the market has the rug pulled under it, which we saw on Thursday. I'm still not seeing a commitment of capital anywhere in terms of, I'm not seeing big players go out and like Apple or Microsoft or Intel and buying, let's say, September options or trading September options. But on the flip side, I'm really not seeing a boatload of hedging, meaning I'm not seeing big aggressive put buyers out there, which usually, especially when we have the market sell off like we did Thursday, usually you'll have funds start to buy protection just in case we continue to trade to the downside. But it's interesting that names that are strong, you really start seeing the option flow gravitate towards them. A lot of tech names, internet software names, especially. You still have that consistent option flow and call buying in them. A lot of these names too, they're spreading out, doing collars and such like that, probably against a long stock position. But the option market, I would say it's pretty neutral to slightly bullish at this time period.
Mm-hmm. Okay, and Roger, last week you and I were talking about some of your favorite indicators, and you were doing interesting things like tracking that 95% of the stocks were over their 200-day moving average. So let's elaborate on that a little bit, because that really sort of resonated with me, and I'm sure other people who are more fundamentally oriented but are being gravitating towards becoming technically focused due to the shorter term sort of advisability of trading at this point. So let me ask you first, here's a multi-part question, which I understand we might not get to the full answer today, but what is the status of those 95% of the companies that were trading above the 200-day moving average last week, A? And B, how have your favorite indicators, and I think we were talking about RSI and Bollinger Bands, but there was another one in there which I can't recall right now. Give us an update on that whole theory.
Let me do that. And while I'm doing that, I'll also comment on what Jeff, Lance, and you said earlier. First of all, and this is all based on those indicators and else. Number one, when Jeff was making a comment how this is not normal, this is not a 700-point days on we haven't had in 5 years. Just to remind everyone, the majority of the stocks, even when the S&P 500 went above the 200-day moving average, the percentage of stocks trading above or below the 200-day moving average had a higher percentage on the downside on the overall stock market. And that has not changed, James. We are still bearish on the overall trend. In terms of the number was 50 days. It was how many stocks were above the 50-day. That was the short-term to medium-term trend. We are still at the 80th percentile. We went from 95th percentile to 80th percentile, and it looks like we're coming down. So now it looks like the long-term trend and the short-term trend are both coming to the downside. Before, we had the long-term trend moving down and the short-term trend moving up. Now they are both moving down. In addition to that, something very, very big happened. If you're a technical trader, we had what is called the death cross today. Have you ever heard of the death cross? It's when the 200-day moving average and the 50-day moving average cross each other to the downside. With the S&P opening down today, and that's a very long-term fundamental, not a fundamental, but a technically fundamental bearish move to the downside. So if you've been trading based on technicals and you see a death cross, that's a big reason to get out. So in terms of the momentum levels that we talked about yesterday, they are now just now confirming what we talked about last week. Last week was a big, hey, you got to see this. It's a rubber band ready to go. Well, that rubber band is moving now, okay? And everything is moving in the direction that we thought it would move to. In addition, we have the death cross. In addition, and this is just, I wanted to interject, but I didn't want to interrupt. Folks, volatility, the VIX index, we never went below 20. At the lowest level, we went to 25. I don't know about you. I know we've been seeing 80, but Jeff and Lance will both tell you, James, that 25 on the VIX is danger zone. It's a lot of volatility. So it's exactly what Jeff was saying. This is not a normal market. We never went to a normal market. Now, in regards to what Lance said, volume right now is, if you look at the volume compared to last year, volume overall is lower. Yep. Typically, when you see lower volume, that means institutional traders are sitting on the sidelines. Retail traders, and we know based on the Robinhood reports we've been seeing, retail traders, small traders are going wild right now. So the majority of the volume we are seeing is retail volume. What do we know about retail volume? Retail volume is not sustainable. It tends to be directionless because retail traders don't have the million and millions of shares to keep that accumulation track going on and on like large hedge funds do. So this type of, based on everything I'm seeing, based on the VIX index, based on my momentum levels, which are just confirming now what we saw last week. And yes, they are just continuing doing the same thing that we anticipated. The 200 is now moving down and the 50 days moving down. We had a month and a half where the 200-day was kind of sitting quietly idle, and the 50-day was just moving up, taking all those stocks with them. Not happening anymore at all. It's all moving south now. So the fact that volume is low, the fact that we are seeing a major technical indicator, the death cross. I don't want to get all Star Wars on you, but that's what it's called. The fact that momentum levels are going lower, I completely agree with what Jeff and Lance are seeing in the market. And that confirms that what I was seeing on momentum levels is occurring in real time right now, James. And this process, remember, it took about 8 weeks, 10 weeks for the momentum levels to get up. It's going to take a while for them to come down. So right now, the long-term trend and the short-term trend are moving south. Now, before I conclude, let me just finish this. In terms of bank stocks, I do like bank stocks. I prefer bank stocks right now that have some trading exposure, that are also institutional trading bank, like investment banks like Goldman, Morgan. In terms of, I would stay away from the savings and loan style banks like Wells Fargo right now. I think that I would just stay away from them. There are a lot better banks. So if you're going to do
Important distinction. I left out. We've been talking about it, but super important.
Yeah, and correct me if I'm wrong, but I think that distinction is the investment banking arm. You want to make sure to invest in banks that have investment banking. Otherwise, you got a savings and loan, and it's apples and oranges. And the other thing I like right now, that's the whole throwing the bathwater, the whole analogy that Jeff made is, I think pot stocks have been really beaten down, and I think we're going to see a lot of value, especially if the economy continues moving south. I think the Fed is going to start looking at each other, and I think full legalization, if not, then a lot more states, simply for the fact they need the money right now. And that is a very fast way to get a big influx of capital, and the whole stigma is moving. So I like investment banks, and I like pot stocks for turnarounds right now. But in terms of the overall momentum levels, it's exactly what we were afraid of, James. It's exactly what we were afraid was going to happen is happening right now.
Okay. I just want to focus on that for a second, on the distinction between investment banks and commercial banks focused on consumers. So, Jeff, you seem to wanted to, sort of draw a line in the sand between the two. And I wanted to ask now, Sarbanes-Oxley, after the financial crisis, was
Yeah.
supposed to cause commercial banks to divest themselves of all proprietary trading.
Sorry. Go ahead.
He laughs. He laughs.
Yeah.
And commercial
Go on.
and investment banks were allowed to, of course, carry on. Your laugh suggests that never really materialized, and in fact, commercial banks might.
I have a lot of friends in at the big boy banks, at the Goldmans, I know a lot of these guys at Merrill, and all that happened was they said, okay, John, take your group of 5 guys, and you're no longer Delta One. You're now called cash derivative market makers, and they do exactly the same shit they always did. And so it's semantics. They got different labels. They do the same stuff. They trade on behalf of the bank and on behalf of clients, which is dubious at best, but it's what investment banks do. It's
Sure.
the reality of it. Anyone, Roger, Lance, these guys are all professional institutional traders. Anyone that's been on the other side of the fence knows how the sausage is made, and it's always going to be made like that. Barring like an Elizabeth Warren, Sleepy Joe Biden presidency, where she takes the wheel in the middle of one of Joe's comas, in which case all bets are off. And, we probably won't be able to do what we do either. So let's hope that doesn't happen. Sorry.
I don't.
There's that. It is an election year. You have to keep that in mind. Through all this insanity, we have this November election looming. Like, we survived June, then you get through July, then you get through August. And then we all know this. Fall comes, and it's the election, nonstop election news. It's polls every day. It's debates once a week. It's going to be an absolute zoo. So if you think we're going to return to normal anytime soon, it's all good for us. We're traders. We love this stuff. But this year is going to be insane no matter how it shakes out.
Yeah. What I want to bring up really quick before time's out is, and I know the audience is probably wanting this question answered, or they have thoughts on this. What Jeff is doing, not to get into the whole political realm, but he's forward looking for the election, right? So he's looking out in time. And I feel like, and I'm glad Jeff brought that up, not to get into the whole who's going to win political situation, but as a forward looking process, because most of the traders that I've been talking to that are not in the business, that are outside the average guy who works the 9 to 5 out there, they're worried about what's going on right now in Hertz, American Airlines, Cruise. Are they a good buy? Are they a good sell? And I get it. I get you guys and girls out there who that's what you want to know. And tell us, Roger, tell us, Jeff, tell us, James. And what I want to bring up, because I don't have a crystal ball. I'm not a medical doctor on the coronavirus front hand right there. I don't know what they're going to do. If I had a crystal ball that gave me the future, great. I don't. But I will say, instead of trying to pick a top or a bottom and the cruise liners and the airliners and Boeing and these names like that, you're basically playing a dice roll right now. If coronavirus goes away next week, guess what? They're all going to rally. If it comes back, they're all going to sell off. Don't get caught up in the mess and, more importantly, the stress of seeing, do I buy AL at 15? The other day it was at 22. Now I'm down X amount. Can I add more? Can I dip buy? Because that's going to create such a headache. And from a short-term point of view, when you see days like today where the market's gapping down and you have some of these stocks down 5, 10, 15%, you're going to get hurt and you're going to not want to do this in 3 to 4 months. You're not going to, you're going to get scared off by the stock market. And if you can survive and let alone make money and thrive during these opportunities when we do have volatility, and use that to your advantage, so therefore you're being proactive and you're forward looking. So when we do have that election, that's going to be the big catalyst out there. You can take not only this experience, but save up that capital and start deploying it in sectors and stocks that are moving there, because that's when you could really make your money. Don't get caught up doing what everyone else is doing right now. If all your buddies are buying Hertz or the airliners trying to, say they're cheap, be forward looking out there, be proactive. I just want to drill that because I get that question so much, and I just say, I don't know. I don't have a crystal ball. I'm committing very little time thinking about cruise and airline stocks, but I'd rather have the conversation of, well, I know when banks report earnings, what's going to be the standout star? Trading revenue. Are all these banks going to have incredible, especially the Goldman Sachs and Morgan Stanley's incredible trading revenue? Oh, they're going to crush it. I've been talking to folks at TD Ameritrade. New accounts have been opening up. So if you look at online brokers, TD, Schwab, Interactive Brokers, keep an eye on those names. Be proactive, be forward looking.
All right. Let's have a concluding remark from you, Jeff. What's the main takeaway then in the context of an election year, and in the context of, like you said, you're waiting for, you think oil's got a lot lower to go. You've got a lot of interesting potential on the table for the week.
I agree with pretty much everything everyone here is saying. We're just kind of saying it in different ways. What Lance just said was extremely powerful and poignant. Why are you, a lot of our friends, a lot of our customers, a lot of people we know out there, especially like newer traders. And I'm not belittling these people. I was them. I made every mistake under the sun. I learned how to trade in a college dorm during the NASDAQ boom and bust. I was self-taught. And then I rushed to get a job in Wall Street because I was hooked. I loved it. It was everything that I loved. But what Lance was just saying is you're in a binary coin flip situation when you're betting on those stocks. They're the central theme to everything because there's a lot of action in them. But because there's so much broader action in the market, you can make higher percentage plays, higher probability trades that make a lot of sense. And that's what Lance brings. That's what you bring, James. That's what Roger brings. That's work. That's the work part. It's not coin flipping. It's not black or red roulette. It's a job. It's full time. You're studying the markets all the time. Forecast. We don't have crystal balls, but we're looking at these scenarios that give us a high percentage probability of making money on a trade. So, the Warren Buffetts of the world, they love to put their big size money into stuff that's going to work 90% of the time just because it's such a good deal. It's so insulated. So people were criticizing, Papa Buffett and saying, he lost it. How did he miss that airline? He didn't lose anything. He made the perfect move at that time. He needs a higher probability thesis for him to do something. So when he sold them, if he sold it by a week or too early or a week too late, it was a 50-50 coin flip at that point. He doesn't do anything 50-50 coin flip. That's what people don't really understand out there. So just because you won on your first time at the horse race, just picking a horse based on its name doesn't mean it's going to be a consistent methodology. There is a science that you should apply. There's people that do it professionally. They handicap the turf. They know which horses run the fastest in certain climates. They know the length. That's what we are to markets. We handicap probabilities doing a lot of research. Last comment on the election. I wasn't trying to ruffle any feathers politically. What I'm saying is, and it kind of speaks to what Roger was saying with the institutional money, you're not going to get any size players until this thing gets final resolution, which it might not even in November, because if you do get this blue wave that people are starting to talk about, what happens when long-term capital rates go to ordinary income? We're talking going from 15%, and ordinary income is going to go up from 39% max, most likely to 50%. You're looking at people are going to rush to sell their stocks before that goes into place, so they don't have to pay 50% ordinary income tax on their stock profit. That could lead to a strange environment in the stock market. So there's a lot of stuff that needs to get resolved this year. There's a lot of overhead in terms of issues that big money wants to see resolved. And until you get that, you're going to get action, which is great for us.
Well said. All right, Roger, let's have your concluding remark for the week, and we'll come back a little later in the week.
I think right now we have to be ultra cautious. I think right now it's not a matter of, it's a combination of staying away from stocks that could potentially be out of business and focusing on stocks making new highs instead of new lows, just as Lance said. I think it's a matter of really being extra cautious because we're in a presidential cycle. There's a lot of stuff going on, just as Jeff said. And I think right now is more importantly than ever, to focus on the shorter term time period because of the volatility and because momentum levels are telling us the markets are softening. So I think the two biggest factors, if that I would take away from this is be extra careful with your overall position size. In other words, it's not about entry or exit, it's about exposure. Your volatility is really, really high right now. So if you're used to trading 1,000 shares, trade 500 shares or 200 shares or 100 shares. There is not a lot of stability, long-term stability in this market right now. Technically, we're again in a bearish zone. And again, so the two biggest things is stay away from losers, from ultra cheap stocks right now. Don't try to find bargains and try to outsmart the market. It's very hard to outsmart the market because you're competing with people who've been doing this for many, many years, like us. Number two, lower your exposure. And three, the technicals are looking bad right now. Things are not looking pretty right now from a long-term and a short-term trend. I will feel a lot better when the percentage of stocks above the 200-day moving average is at 65, 70% instead of 35%. I will feel a lot warmer. I will have a lot more warm and fuzzy feelings about this market. I think that's a good conclusion there.
Okay, great, Roger. Well, a lot of interesting food for thought there this week, gentlemen. Thank you very much for your time, and we'll come back to you each individually throughout the week. Have a great trading week.